Hello everyone, I hope you're all doing well today. So today we're going to be talking about a very important concept in investing, maybe the most important concept in investing. What we're going to be doing today is called fundamental analysis. I'm going to be honest with you. Today is probably going to be a bit of a drag. There's going to be a lot of math today, a lot of memorization. Well, maybe not so much memorization, but just I'm going to be throwing a lot of knowledge at you, and I might have to end up breaking this video into two parts, maybe. We'll see based on time, but this might take a while, so please bear with me. Today's going to be probably a pretty difficult lesson. I think it's the most advanced stuff I'm going to be teaching you in this course, but it's very important. And if you understand this stuff, you're going to be way ahead of the game. If you are able to understand this and internalize it, you're going to be better than most investors out there right now, which hopefully is pretty exciting to you. So let's begin. First, what is fundamental analysis? I'll give you a complicated definition first and then a simpler one. The complicated definition is we're examining financial factors to calculate a stock's intrinsic value. What the heck does that mean? Well, let's break it down a bit. Put it more simply, we're using financial factors. We're using a company's financial situation to find out the best stocks to buy. So essentially what we're doing here is we're breaking down a company into much simpler parts, much smaller and simpler parts in order to understand it better. This will help us to take a very complicated dynamic thing like a company and make it much simpler, and we'll be able to understand it better that way. We're going to start by talking about one of the most important and most talked about concepts in investing. That's called valuation. And there are three keywords in valuation that I want to talk about. The first one, the most standard one, is the fair value. The fair value is when a stock's price makes sense based on its price compared to others. That's pretty complicated, but I'll write it down. What we're basically saying here is that the price of the stock right now is about right. It's what you'd expect the price of the stock to be. Now, it follows that we have two other words, undervalued and overvalued, which should be, if you understand fair value, they should be fairly self-explanatory. When a stock is undervalued, it means the stock is cheaper than it should be. In other words, you're getting a good deal. If we're not talking about stocks, if we're talking about, for example, clothes. Let's say you're buying clothes and you go to like your regular like department store and get a shirt. And the shirt, like, let's say like it's a pretty good shirt and it has a pretty expected price. That would be at a fair value. Then let's say you go to like a thrift store or something where everything is much cheaper and you find the same shirt. But because everything's cheaper, that shirt would be undervalued because it's cheaper than it should be, and you're getting a good deal. On the opposite end of the spectrum, we have overvalued. That means, pretty self-explanatory, it's more expensive than it should be. In other words, you're getting a bad deal. You're paying more than you should. So going with the clothes analogy, let's say you go and shop at some like designer store like Gucci or something. The clothes there, and let's say you find the same shirt. Obviously, because it's at Gucci, it's going to be way more expensive than it should be. The clothes there cost maybe like upwards of $2,000. So it's much more expensive than it should be. We'll say it's overvalued. So hopefully this kind of makes sense. Valuation, you'll hear about it talked a lot, and it's really the foundation of fundamental analysis. But you might be wondering, like, this is pretty abstract. This is pretty abstract. How can we quantify the fair value? What is the fair value? And the answer is, like, there's not really a good answer for that. There's many formulas that attempt to find the stock's true value, but are any of those really accurate? Not really. But I'm going to get a little later. I'm going to get into the most common way to value a stock. But before we get there, I want to revisit an old friend. If you remember from the intro to stocks video, I believe I showed you this Apple stock page on Yahoo Finance, and if you see, I still have my old markings from that video, and I told you that we're gonna stay away from this side here because like it's scary. It's scary. It's very complicated. Well, we're gonna look at it right now. We're gonna delve deep into this. So I hope you're excited because I'm sure you've been waiting with bated breath for this. So let's dive right in. Let's take a look at this first thing, market cap right here. Market cap. What is market cap? Market cap is really it is how much the company is worth. It's the total value of the company. So let's write it down here. It stands for market capitalization, but everyone just abbreviates that market cap because it's so much easier to say. So market cap is the total value of a company. How much the company is worth. And how do we measure that? How do we get this exact number of $2.642 trillion? By the way, this is kind of outdated. This number is different right now. But so how do we determine that? And the answer is that we take the number of shares, the total number of stock in a company, and we multiply it by the price per share. And if you think about it, this should end up making sense because the shares are in a public company that is traded on the stock exchange. The number of shares is the shares that really just represent a part of a company. So if you take all those individual shares and multiply it by how much they're worth at the moment, then you get the total value of the company. So hopefully that makes some intuitive sense. Going back here, we're gonna skip beta. Beta is important, but not really that important, and I don't really want to get into it. I'm gonna talk about PE ratio and EPS soon, but we're gonna jump over that for now because they're much more complicated. Earnings date is pretty self-explanatory. It's when the company is going to release their financial information. If you remember, a public company every quarter has to release financial information about themselves. And actually, in this video, we're going to be looking at that financial information and really analyzing it. So look forward to that. We have forward dividend next. Oh, bring it back here. We have forward dividend and yield. So forward dividend and yield. You see we have two numbers here. we have this 0.88 and the 0.55%. So the forward dividend, this part, is gives us the dividend amount per share, the flat amount, the dollar amount per share. So if you have one share of Apple, then every quarter you're going to get 88 cents. And this 0.55%, that is a yield. The yield is the percentage dividend of the share price. So I haven't calculated it, but I will trust the folks at Yahoo Finance. If you take the 0.88 and then divide it by the 161.02, you should get around 0.55%, and that is the yield of the dividend. So it's how much, it's the percentage of the total price that the dividend is worth. And then the last thing we have here is ex-dividend date. That is just the last day to buy the stock and still be able to get dividends. Remember, the dividends are paid out every quarter. So if you own the company stock by November 5th of this was in 2021, so this was a while ago when I printed this out. But if we were in 2021 and if you own shares of Apple before November 5th, 2021, then in the quarter you would be able to get dividends. That's just what it means. And then we're gonna skip this 1 year target estimate. These are just estimates of the stock that like professional analysts, bankers think that this stock will reach in 1 year. We're not going to look at that because we're not interested in that. So now we're going to jump back to the two things that we were talking about that we skipped, EPS and PE ratio. These are probably the most common ratios that you will ever hear in stocks. We're going to start with EPS. EPS stands for earnings per share. Earnings per share, and it is calculated by doing net income divided by shares. So net income is just the money that the company has, that the company brings in after all expenses are taken out. So it's basically the final, it's just profit, basically, the final profit. And what this tells us is, if you think about it, if you analyze the ratio here, it tells you how much the company makes for every share. Right? We have net income, which is how much the company makes, and then we're dividing it by shares, so how much the company makes for each individual share. And so the EPS is a measure of profit. This tells us that it's a measure of profitability. Right? We'd expect that the higher the EPS is, then the more money the company is able to make, just based on each share. But what I want to make clear is that by itself, the EPS doesn't tell you much. It doesn't tell you much because each individual share or each individual company is going to have different net income, different shares, a different number of shares, and so it's really hard to use EPS to compare between two companies, which is what we want to do in fundamental analysis. Remember the definition of fundamental analysis. We want to, and in particular valuation, we want to compare a stock's price to other companies. And so with EPS, it's kind of hard to do that. So you might be asking, well, what's the point of EPS? Why do we need to know it? And transition, you might be able to guess, but the the EPS can be used to get the PE ratio. The PE ratio, which is probably the most important ratio in investing. And the PE ratio, what it tells you is well, first of all, what it stands for price to earnings ratio. How to calculate it is the price per share divided by EPS, earnings per share. That is the PE ratio. And this is a measure of valuation, which this is the most commonly used way to measure valuation, which is what I talked about earlier. So, what is it? Well, the PE ratio tells you how much money. This is going to be pretty long-winded definition, but it tells you how much money you pay for every $1 that the company makes. For $1 that the company makes. What in the heck does that mean? Well, if you think about it, we're taking the price per share, so each individual money divided by the amount of money that the company, the amount of money that the company makes per share. So if you analyze the units here, if you analyze the ratio here, you'll find that it's basically telling you how much money you're paying for $1 of profit. How much money do you have to pay for $1 of profit? And to sort of consolidate this complicated definition, let's say that the PE ratio is 5. What this tells us is that for every $5 you invest in the company, for every $5 you give the company as an investment, the company makes $1. If you look back at our definition here, this is what the PE ratio tells us. For every $5 that you put into the company is able to generate $1 in profit. And now let's say the PE ratio. Let's say a different company has a PE ratio of 200. Well, following a similar definition, every $200 you invest, the company makes $1. So, let me pose a question. Which one would you consider the better deal? Which stock would you be more interested in buying? Well, clearly, you want to buy this one, right? For every $5, if the company is able to get $1 for every $5 you put in, versus $1 for every $200 you put in, it's pretty obvious that this one is less expensive, right? And this one is more expensive. So, in other words, this one's undervalued, this one's overvalued, if we go back to our valuation definitions. So you might think, and a lot of people do this, that we just buy every single stock that has a low PE ratio, because a low PE ratio means that you are getting a better deal because the company is able to generate more money based on the money you invest and grow more. Unfortunately, it's not that simple. So we're gonna call this warnings or caveats. Unfortunately, you can't just buy stocks based off of if they have a low PE, right? You might think that, oh, if it has a low PE, that means it's a better deal, and that means it's undervalued. That means that I want to buy it because I'm getting a better deal out of it. Unfortunately, it's nothing in life, and especially investing, is ever that simple. If the PE is low, if the PE is low, that could mean the company is not doing well. Could mean the company is just not doing well. Right? because if they're not earning a lot of profit, then our if we're not earning a lot of profit and the company's not doing well, then people are going to want to sell the stock. It's going to drive the price here. It's going to drive the price of the share down because people don't want to be investing in it. They're going to sell it, and the price is going to go down. And when the price, the numerator here, the price per share is down, that means the entire ratio goes down, right? That means the PE ratio goes lower. But the reason it's going lower is not because it's undervalued. It's not because it's undervalued. It's just because it's not doing well. And so we definitely don't want to be investing in those companies because they're not going anywhere. They're just not doing well, so the price is low. On the other hand, if the PE ratio is high, normally you want to avoid it because it's overvalued, it's expensive, and you don't want to buy it. However, it could mean it could just mean that the company is not making a lot of money right now. But it's preparing to grow a lot in the future. So if it's not making money now, that means that the EPS here, the denominator, is low because we have net income in the denominator. So if it's not making money now, EPS is going to be lower, and the PE ratio will go up. But it could be not making money now, but people expect it to grow a lot because it's like a high growth company. A lot of really high growth, a lot of growth stocks are gonna have really high PE ratios because high growth companies typically don't make a lot of money when they're younger, but they prepare to make a lot of money in the future. So that'll result in a higher PE ratio. If we take an example like Tesla has a very, very high PE ratio because people, well, especially when it first started, it was not making a lot of money, but people expected it to grow a lot, and it sure did. And so we can't just rule out high PE stocks because they could just be really high growth. So as some final thoughts, the PE is a powerful tool, but it shouldn't be your only tool. We're going to cover other tools that we can use to get a better picture of a stock. And then the last thing I want to say about PE is that what's considered a quote unquote good PE ratio depends on the average PE of all companies in the industry. You can't really compare PE ratios across industries because the total earnings are going to be different. So you want to compare within one industry when you're considering like if the PE ratio is good or bad. A rule of thumb that investors like to do is a PE below 15 or 20% or 20. This is typically that's a general rule of thumb, but really, you really want to, if you want to get a really good picture, you want to compare, but within the same industry. So like you can't really compare a company, say like in healthcare, with a company, say in tech, because the two are different industries. And a good website that you can use to compare the PE ratio and the industry ratio is Seeking Alpha. Seeking Alpha will tell you the PE ratio compared to the average, the industry average. So it's a really good website. I really like this website, so I highly recommend using it. The PE ratio and the EPS are very important. That's why I made it probably the bulk of the video. But now we're going to dive into more other ratios that are very commonly used. And before I want to do that, I want to talk about financial statements. Financial statements is just financial information. It's information that's released every quarter about the company's financial situation. If you remember, like I said, public companies have to release this information every quarter, and because it helps investors make more informed decisions. And that's just what I'm showing you how to do now, how to make informed decisions using these financial statements. And there's three big ones. We have the balance sheet, the income statement, and the cash flow statement. I believe that these two are the most important ones. They're the ones that I know the most about. I really don't know much about the cash flow statement at all, and it's really not used as much as the other ones. So we're going to be talking about mostly the balance sheet and the income statement. I will show you the cash flow statement, but I don't know much about it. I'm not going to go very in depth into it. We're going to start with balance sheet. What is a balance sheet? Well, it's a summary of what a company owns and what it owes. Two similar but very different words. Company owns and owes. And in particular, there are three main pieces of information that a balance sheet contains. We have assets, which are what the company owns. Some examples are cash, inventory, and equipment. Right? These are all things that are worth money that the company has. And then we have liabilities, which are what the company owes. And some examples that I'll throw out: loans, rent, insurance. Very common liabilities that a company has to pay. And then we have the biggie, shareholders' equity, which is you may have heard of the previous two, but you probably have not heard of shareholders' equity. What the heck is shareholders' equity? Well, really, shareholders' equity is the net worth of the company. It is calculated by taking assets and subtracting liabilities, which hopefully should make sense because it's taking all the stuff that the company owns, all the money that it has, and how much is left after subtracting all of the debts that it has to pay. So hopefully that makes a bit of sense. And using the balance sheet, what's the point of it? Well, we can get an idea of how solid the company's financial situation is at the moment. I will now show you a balance sheet that I have. I printed this out. I took it from Yahoo Finance. I'll just put it here at the very top so I'm not like stealing it. Yahoo Finance. And this is Tesla's balance sheet. If you look here, you have assets here. You can see assets is broken up into two separate things. We have current assets. Current assets are you don't really need to know the difference. Actually, no, you kind of do. Sorry about that. I will write it down. Current assets. I should have written it up there, but I didn't think to do that. That's my fault. Current assets are assets that can be converted to cash. converted to cash within 1 year. So like cash, obviously cash can be converted to cash within a year. Cash is the current asset. Inventory is the current asset. It can be sold pretty quickly. And then we have non-current assets. It takes more than a year to convert to cash. So like a building, for example, building, land, these are all non-current assets because they take obviously more than a year to sell off. So here we see we have current assets, cash, receivables. I'm not going to go into, but they're another current asset. Inventory, and then here we have non-current assets. PPE is, I believe, property, plant, equipment. I could be wrong there, but that is essentially what we just talked about, like the actual like equipment and the buildings. And then liabilities here. I'm not going to write it down, but current liabilities are liabilities that have to be paid within a year. And why not? I'll write it down. Paid off within 1 year. These are like very, very short-term debts that a company will take on and pay back like pretty quickly. And then non-current liabilities, obviously, paid off in more than a year. I believe rent will be considered a non-current liability because you have to keep paying it. A mortgage will have to be paid off much longer than 1 year. Just some examples. And then at the very bottom we have stockholders' equity. Shareholders' equity, stockholders' equity, same thing. Here they call it stockholders' equity. It's really the same thing. And you can see it's taken after subtracting all of our total liabilities from our total assets. So this is one example of a balance sheet that you will find. And now we're going to talk about some ratios that can be taken from the balance sheet. So some actual direct application. Mark this. Ratios. What can the balance sheet tell us? The first ratio I want to cover is the current ratio. Current ratio is calculated by taking the current assets and dividing it by the current liabilities. This is why I decided to actually go in depth on what the difference between current and non-current assets and liabilities are, because I knew we'd have to cover it here. The current ratio, it tells us how easily the company can pay off all immediate debts. With the money that it has on hand. So how easily can it pay off the debts that it has to pay off soon with money that it can easily get its hands on? And so clearly the higher the better. Because that means that it can more easily pay off all of its immediate debt and still have money left over. If it's below 1, if the current ratio is below 1, that means that the company can't pay off immediate debt easily. That is bad. That means the company is probably in trouble, because if it can't pay off all of its immediate debt with the money that it has on hand, that means that it could have a lower credit score. It could even be forced to close if it can't pay off all that debt. So So this will tell you that you really want to try to avoid companies with lower current assets because they could be in trouble. So that's what the current ratio can tell you. A similar ratio that I want to cover is the debt to equity ratio, which is slightly more complex. Actually, significantly more complex. Pretty simple, pretty straightforward definition. The total liabilities divided by shareholders' equity. We're going to abbreviate it EQ. And so this definition is pretty complex, much more complex than the current ratio, so I'll do my best to explain it. It compares how much debt the company takes on to pay for all this stuff. Let's say stuff. Stuff could be anything like equipment or just starting the company. How much debt the company takes on to equity used to pay for stuff. What do I mean by that? I feel like I've said that a lot this video. What you need to understand is that there are two ways for a company to raise money. We have debt, which is like taking out loans to raise money in order to start a business or to keep operating the business. Obviously, you have to pay back a loan. And the other way is equity. When the most common way to use equity to operate a company is to sell stocks. Remember when I talked about in the second video what an IPO was, an initial public offering? IPOs raise a crap ton of money because if you think about it, they're releasing millions and millions of shares. Each individual share could be worth like $30. Let's say that's a lot of money. So and the best thing is you don't have to pay anything back when you sell stock. So when you use equity, I'll write this down. You have to pay back on debt, but you don't have to pay back with equity because people are going to be buying your shares. So you're really just selling them. You don't have to pay anything back. So clearly, it's better for a company to be funded mostly by equity over debt. Every public company is gonna have both debt and equity, but it's better to be funded by equity more than debt because that means because you don't have to pay back equity, and so I'll just say lower generally means less risk because there's not as much debt to pay back. Which should hopefully be pretty straightforward. However, as always, we always have to have a caveat, a warning. Debt to equity ratio, it's not usually abbreviated DE, but I'll do it to save time. Debt to equity ratio being high is not always bad. If a company takes on a lot of debt, to finance a big project, and if that project pays off, and it starts bringing them back in much more money if it's successful, then the stock could skyrocket. Big growth companies often have high debt to equity ratios because equity is not enough to finance them. So they have to finance their operations to pay for these big growth operations. So they take on a lot of debt, and in the hopes that it will pay back, and shareholders buy into that because they're probably going to be successful. Moving on. to the income statement. The next financial statement, also called the profit and loss statement. What it lists is it lists revenue and expenses. Revenue is just money being made. Expenses is money lost. Money they have to pay. Here, let me show you the income statement for Tesla, also taken from Yahoo Finance. Tesla. You can see we're listing a lot of stuff here, and I'm going to talk about what each one of these is. At the very top, the largest number you'll have is total revenue. I'll just list it as revenue here. Revenue is at the top of every financial statement. Revenue is the total amount of money brought into the company. No expenses have been taken away from it. So it's just the flat total amount of money brought into the company without anything taken out. You see here it's at the very top, $62 million. Next thing we have here is cost of revenue. It is often abbreviated as cost of goods sold, or not abbreviated, but often called cost of goods sold, and abbreviated COGS. Do that. So what it is, it's all the expenses related to like actually making and selling the products. So like the cost, so like buying the materials to actually make a product. Advertising. Before I go any further, I should make it very, very clear that if you look at stuff online, oftentimes the lines are very, very blurred between what is COGS, what is everything else. The definitions are never very clear. These are the most common definitions that I learned and that I know of. But you may find that like another website tells you a bit differently. Some websites may say that advertising is not included in COGS. I just think that it is, so I'm including it here. But some websites may say it's not. So just be careful when you're looking on the internet. Internet's a scary place. Next, gross profit. We're just going down the list here. Gross profit is revenue minus COGS. Also, COGS is also, there's another word for it that you might hear. I'll put it here, direct costs. Here called direct costs because it's directly related to the manufacturing of the product. So that's another word here. Gross profit, revenue minus COGS. We're going down. We're slowly getting smaller and smaller. Now we have operating expenses. Is all expenses related to just running the business. So not like actually making the product. Like for Tesla, the direct cost, the COGS would just be like the materials to make the cars, like the steel or whatever. Operating expenses would be things like wages, rent, utilities, etc. You'll hear the word indirect cost, overhead. All of these are essentially the same thing. Now we have operating income. You might be able to guess. Operating income, we're just going down. Operating income is the gross profit minus operating expenses. I don't know if you can tell, but my marker is running out because I've been using the same marker for every single video. So it might soon be time for a replacement. But yeah, operating income is the gross profit minus the operating expenses. We are almost there. Last here, we have net income at the very bottom. The bottom line, as people say. Net income is the very last thing. You can say it really is just revenue minus all expenses. If you want to talk about like keep going down, like you might be asking like, oh, what else is there besides like what's the difference between net income and operating income? What's the other expenses there? You can say operating income minus things like various expenses. I'll just put it here in parentheses like taxes, depreciation. Taxes is a big one. There's a lot of like smaller things that are not included in either operating expenses or COGS, so they're just thrown at the end. We subtract them from the operating income and we get net income. Net income is the very last thing. What's left after paying for all expenses? See here, Tesla's making a pretty solid amount of money. I believe this is also in thousands, so add 3 more zeros to the end, and I think you get the actual net income, which is a lot of money. So, finally, going back to the so this is all the definitions. Keep in mind, you don't have to memorize all these. I have these all memorized because I've been like looking at them for a long time. I've just been like staring at them for a long time, but you don't have to. There's websites out there that will tell you what everything is. So it's really not needed for like casual investing to memorize all of them. Just like know generally what they mean. And now there's one really important ratio that you can get from this, from the income statement. That is the profit margin. One of, I think, the coolest names for ratios in investing. Profit margin, net income divided by revenue. So we're taking the bottom line here and dividing it by the top line here. What does this tell us? Measure of profitability. So it's if you look at the ratio and analyze it, what it really tells us is how much profit, how much money the company keeps. The company takes for itself. How much money the company takes for itself per dollar made, per dollar like brought into the company. If you remember, total revenue is the amount of money, the total amount of money brought into the company without any expenses taken out. Net income is after all expenses are deducted. It's the total final profit. And so what the profit margin says is how much money the company actually keeps for every dollar that's brought into the company. So as an example, if the profit margin is 15%, this means that for every dollar made, for every dollar in revenue, dollar made, the company keeps 15 cents, right? 15%, 0.15 is just of a dollar, is just 15 cents. So for every dollar the company makes, the company keeps 15 cents. This is, I want to say it's lower than I would like to see. 15 is lower. I'd like to see a profit margin of about 30%, but as is the PE ratio, good, depends on industry. One salient example that sticks out in my mind is grocery stores. Grocery stores have the retail industry in general has very low margins because there's so much competition, and they're able to take such little profit. So you can't really compare a retail with something like tech. So that's something that I want to point out. But really, I'd like to see a profit margin of about 30% is what I say is pretty decent. So 15 on this end is kind of low. I want to close. I think I am going to separate this into two videos. So for this video, we're going to call this quantitative, the quantitative side of fundamental analysis. To close, I'd like to discuss cash flow statement. Cash flow statement tells us, it describes the movement of cash in and out of a business. This marker's really, really fading. I don't know if you can tell. But yeah, I'll probably replace it. So talks about like the where cash is going in and where it's going out. And if you think about it, it really is kind of similar to the balance sheet and the income statement, which is why I think it's less important. But there are some good conclusions you can draw. I'm sure if you look it up. I just think the balance sheet and the income statement really cover everything you need to know. But here I'll just quickly show you an example of a cash flow statement. Yahoo Finance again. And Tesla. So really, if you look at, we can see that this much money is flowing in from the operations of the company, like its daily operations. They're losing money through investing. They're investing in maybe like equipment, research and development. They're losing money. The money's going out of the business there. That's what the negative implies. Financing, what they're using to pay for their operations, like that could be like debt. We're subtracting money, and here we see we're ending our position with this much money at the end of the time period. We're starting with this much, and we're seeing this much in changes in cash. So this we can see between the start of the period and the end of the period, we gained this much money. This much money flowed into the business, which is basically what the cash flow statement tells you. But like I said, it really sounds similar to what we've covered before with the income statement and cash flow and the balance sheet. So I don't want to spend too much time on this because I don't know much about it. I think it's maybe a bit redundant. But there are also like a lot of ratios about it. So if you want to dig deeper into it, by all means, go ahead. All the power to you. I think you'll be just fine with the income statement and the balance sheet. So I'm gonna leave cash flow statement off from here. This was the quantitative part of the fundamental analysis, and as you can tell, we're almost at an hour here. So I'm gonna stop the video here. We're gonna talk about the qualitative side next of fundamental analysis, which should be a lot shorter, I think, but it's much less tedious, I would say, than the quantitative side. It's much more much easier, I think, but you also have to do a lot of research into it. I'll cover that later. Thank you for watching. Hopefully I didn't bore you out too much. Quantitative fundamental analysis is a drag, I know, but it must be done. And you don't have to do, I'll say you don't have to do the calculations. Most websites will tell you each individual ratio if you look for it. I know Yahoo Finance gives the profit margin like pretty clearly. Seeking Alpha does too. So you don't have to calculate it every single time you look at a company. You don't have to calculate each individual ratio. It'll be there for you. I just want to introduce them to you. Make sure you know what they say, you know what they are, and you can use it to research companies and figure out which companies are the best to buy. So hopefully this was helpful. This is if you understood this video, like I said at the beginning, you are doing very, very well. You're ahead of the game. You're better than most investors out there. So this is powerful stuff. Good luck using it, and I'll see you next time. Thank you.